Hello everyone. On the behalf of Coface, thanks for being with us today. So my name is Julien. I run the economic research team. So it's a team of worldwide economists, so based all around the world, and working to try to anticipate macro trends, sector trends, micro trends in collaboration with all our credit analysts. We have hundreds of them all around the world too. And so, as I said, I mean, we used to look at macroeconomic trends on a sector-by-sector basis, what's going on politics. And this year, like everybody else, of course, we also have to look at what's going on at sanitary level, and this is new for everybody. And let's start quite fast. So, as I said, I mean, this year is a very specific one, is a very singular one, where we have to, unfortunately, to try to look at this type of data on a country-by-country basis. Now, you're used to it almost everywhere in the world. And I would say the very good news, the very recent good news, is that now a number of vaccines have been announced. So the question of the vaccines is not a question of if anymore. It's more a question of when. I mean, when vaccine will be widely available in most countries. How fast can we produce this type of thing, and how fast can we distribute this type of vaccine? So now those are the key questions, and that will drive the economic outlook. And on this side, I mean, we think the world is going to remain split into different categories. One category is composed by countries that are moving fast out of the COVID-19 world, and they have already started to enter into the, let's say, post-COVID-19 world. But on the other side, if we expect that it's going to take some time to produce this vaccine, it's going to take some time to distribute it. A second category of countries, at least in the first half of next year, will still have to deal with the pandemic. And the key differentiating factor in all regions, all around the world, is that can a given country manage well the pandemic? Can a given country have an effective testing strategy, an effective contact tracing strategy? This is a key differentiating factor, and it will remain the same at least during the first half of next year. And so this applies to the world, and this also applies to Asia. You see what has happened in Asia in the last month. On the one side, in the top, countries which had an effective strategy to trace contacts of cases, to countries that were good at testing, they didn't suffer much from the pandemic, and you see them on the top of this chart. Of course, in the bottom, the situation is very, very different in other countries in the region, including the Philippines, including Indonesia or India. Where here, I mean, we can put those countries in another category where the pandemic is not under control yet, and unfortunately, those countries will still have to deal with some kind of stop and go, at least until the end of the first half of next year. And some other countries that are right in the middle, inside the orange bubble, those countries are in a mixed, let's say, in a mixed position. I mean, frankly, the pandemic is not the only one driving factor behind the GDP growth performance in 2020. But of course, this is the most important one, the key one, but you have other ones. And of course, since you see that China is definitely the growth driver of the region this year, as usual, but perhaps even more this year, because China has dealt well with the pandemic so far. Of course, countries trading a lot with China, and countries trading a lot of products that were quite resilient in the midst of this mobility crisis, for instance, electronics or pharmaceutical products. Those countries have also benefited and did not suffer much from the crisis, and you see them again on the top of the slide, like Korea, Vietnam, or Taiwan, just to name a few. And so, as I said, I mean, trading with China, depending on China, was definitely a plus this year for Asian countries. So, you know the story. China entered first into the pandemic crisis, and China exited first the pandemic. China was very fast to exit and to foster its domestic recovery by using what we can name, let's say, old-fashioned recipes. You remember what happened after the 2008-2009 crisis in China. Authorities fostered investment driven by state-owned companies that was made it possible thanks to very cheap credit conditions from large banks. And of course, it made it possible to foster a fast recovery in the short term in 2008-2009. But of course, the negative side is that it also was a source of the build-up of a huge amount of corporate debt. You see it in the orange bubble. And we have talked about this issue in China in the last 10 years. The point is, China has used kind of same recipes, tools this year. And of course, it means that we already know what's going to happen. On the positive side, the recovery has been driven positively by state-owned enterprises, and that's why recovery went very fast from the second quarter of the year. But the increase of corporate debt driven by this recovery is about 2/3 of what we saw in 2008-2009. So the increase you see inside the green bubble is about 2/3 of the one inside the orange bubble. And just to give you an example, this is the fastest increase in corporate debt this year in the whole world. Of course, there are a few exceptions, like few emerging countries that did even worse. But this is clearly also something to have in mind. So fast recovery, but fast recovery driven by a buildup of corporate debt. And I'm sure you've heard the news with this steady and regular increase in number of defaults, especially of state-owned companies. And this is something you have to get used to, because this is a kind of a new normal. This increase in corporate debt has made it possible to smooth the crisis, the effect of the crisis. But on the other side, it will also lead to higher credit risk in the months and in the quarters ahead. So the second step of the recovery, after an investment-led recovery driven by state-owned companies, the second step was, of course, a quite fast recovery of private consumption. And this is also definitely a good news. I mean, the Chinese consumers are back. They're consuming more automotive than they used to consume last year. They're also consuming some other luxury products numerously, and this is definitely a good news. Now, if you want to see the glass half empty and not half full, we have also to recognize and to highlight that this recovery of the Chinese consumers is a bit uneven, because of course it looks like it has been mostly driven by high-income consumers that have, of course, bought a number of durable goods. But on the other side, low-income consumers have not recovered much, and they are even in a much worse position than they used to be before the crisis, in terms of debt and so in terms of income, as you can see on the chart, which is on the right. So at macroeconomic level, the recovery has been fast in China, and I think on this side, China is a kind of front runner, and we will see quite the same in the rest of Asia and in the rest of the world. But on the other side, you have to keep in mind corporate debt is now much higher, and income inequalities and inequalities relative to private consumptions have also increased in China and in the rest of Asia. So this is something to have in mind, because this could lead to some kind of social frustration in the months and in the quarters ahead in China, but also, of course, in a lot of other Asian countries and also in the rest of the world. I will go back to it in a minute. So I was saying, of course, China's recovery has been mostly driven by domestic demand, but export performances have been more than decent. And one of the reasons of this is, of course, exports have been partly driven by some products related to the pandemic, and you see it on the chart, which is on the left. Medical devices and even the component, which is like textile, it's mostly masks related to the pandemic. Beyond this, let's say, one-shot event, and of course, it will perhaps not be the same next year. Of course, as I said, China's exports have also been driven by resilient sectors globally, and electronics is definitely one of them, especially electronic products related to home appliances, because of course, as you know, if we stay at home, we need some appliances, and a lot of Asian countries have some added value and competitive advantages in this field. So in terms of regional trend, what does that mean? It means that China has exports China's exports have remained distant with its key export partners. You see it on the chart, which is on the right, and even with countries where there are few geopolitical tension with, like Australia, for instance. Exports to the U.S. Have also stabilized compared to 2019, meaning that, of course, the worst of the protectionist war, the trade war, is now behind us. And as you can see on the left of this chart, the key negative surprise came from Asia. And on this side, we can perhaps blame two things. First, the very bad economic outlook in India in terms of domestic demand. And second one, of course, the call for boycott related to political tensions between the two giants in Asia. It doesn't help. And so the good news is for the rest of Asia, trade of Asian countries has been also driven by this recovery in China. And this is very easy to see on this chart here on the left. And that's part of the reason why a lot of Asian economies, a lot of Asian exporters have remained resilient this year, even though the pandemic has had a huge impact on global growth. Now, looking forward, what can we expect? Again, here the good news is we have had a very good development in recent days with the final announcement and communication regarding this huge trade agreement. This is by far the biggest in the world. This new trade area resulting from the RCEP agreement is bigger than the NAFTA agreement in North America. This is also bigger than the European Union. Of course, it's not going to be implemented in the very short term. We need that 3 non-ASEAN countries ratify it and 6 ASEAN countries ratify it before it comes into force. So it's going to take some time, but definitely it will mean that in the next 20 years, about 90% of products will not suffer from trade barriers anymore within this region. So we can expect the biggest positive impact will relate to the trade between China, Japan, and Korea, because those countries didn't have any free trade agreements between them. And we can also expect this is going to have a big positive impact on sectors like automotive, steel, textile, because they are the ones that suffer the more from tariffs at the moment, and so they are the ones that will benefit the most from the lower tariffs in the coming years. So that's the outlook for Asia. This is definitely the front runner in the world, and the situation is better than the one we can see in a lot of other countries. I started my presentation by saying that the world is going to be split into different parts, and some parts, including the US and including Europe, will still have to deal with kind of a stop-and-go strategies in the first quarter of next year. So those countries, including the US, will face difficulties to move out from the COVID-19 world and from the COVID-19 crisis. The good news is, even in the US, I mean, if you look at numbers, the recovery after the first wave of the pandemic was quite fast, and you see it on the left here. But again, even if the recovery was quite fast, we have to highlight that the shock was huge. And despite the recovery, you see that the scares and the consequences on the job market in the US remain quite large. And that's the reason why the situation will remain quite difficult in the US in the months and in the quarters ahead, as you can see on the right. All the more since now we have entered the second wave of the pandemic, and since this country is not having a well-working strategy in terms of contact tracing and testing. Again, as I said, we can expect some other stop and go in the months and quarters ahead, and some other impacts at macro level. Same thing in most countries in Europe, and you know it. We have entered the second wave of lockdown since early November. So of course, this second wave of lockdown in Europe are not expected to have the same impact as the ones we recorded during spring. All in all, we can expect this second wave of lockdown is going to be 50% less painful than the first one. But even 50% less painful, it's still very painful, and it's still going to be very painful in a number of sectors. The ones we know very well, and they are in the bottom of the chart, which is on the right. And of course, they relate to a lot of services activities, but even some manufacturing activities, even if they are allowed to produce and businesses are open, we can expect a lower demand because of this lockdown, of course. So the paradox of this crisis is that we are seeing the worst ever crisis since World War II in the US, in Europe, from a macro standpoint. But from a business standpoint, business insolvencies have not even started to increase. And you see here the charts regarding some European countries, Germany, France, the UK, and just to name a few. Of course, in some specific sectors, the well-known one, the usual suspects, like textile clothing, metal, automobile, the ones that were already suffering before the crisis, in those sectors, the situation is still tricky. But all in all, the overall situation is that at this stage, businesses have not started to fail massively in Europe. And so it's a paradox, and the rationale behind this paradox is of course very simple. In a number of countries in Europe, in the US, but not only, you see them on this table, there have been unprecedented and massive government support measures, like guaranteed loans, furlough schemes to support the job market, and last but not least, in a number of countries, some temporary changes regarding business insolvency procedures. And those changes regarding business insolvency procedures, they are, of course, explaining why we don't see much business insolvencies at this stage. But they also are the reason why we could see more business insolvencies next year, even though we are going to enter into recovery time next year, and that's going to be another paradox. And you see in the bottom of this table that, by the way, it not only applies to mature economies. I mean, those schemes, those government support programs, they have also been applied and decided in a number of emerging markets, especially large ones. And again, I repeat myself, but the key point regarding the emerging world is that if we look at 2020 and 2021 as a whole, we can, of course, have a very clear picture of the situation. And this situation, again, is very different from one country to another. If we aggregate our GDP growth forecast of 2020 and 2021, because of course in most countries in 2020 we will have a deep recession, and in 2021 a huge rebound. But if we combine both, you see our top 15 countries on the left in terms of GDP outlook between 2021 and 2019. And so on the top 15, it's not surprising, you will see half of them are in Asia and half of them are in Africa. And on the other side, on the right, you see the bottom 15, so the worst ones in terms of GDP outlook. And on those ones, half of them are in Latin America, and you also see some other big names like South Africa. And I think this is a pretty good summary of the situation at macro level. Why the worst one on the right? Because in a number of emerging markets, central banks, governments don't have the means, the tools, the space to support businesses. So in those countries, it means that governments are now facing tough choices. They are now, like all other businesses, all other governments in the world, are thinking about their 2021 budget, and they have two choices. The first one is they keep spending a lot next year. But in that case, the risk is that there is a sovereign default. And we will see a number of sovereign defaults in the emerging world next year. If they want to avoid a default, governments have to cut spending. And that's what they are deciding at the moment. But the problem is that you know the story. If they cut spending massively while the economic situation is not good, there are going to be a lot of social frustration. And we go back to what I said regarding Asia. And just to give you a very recent example, the parliament in Guatemala in the last weekend has been set on fire by protesters just because they heard about the 2021 budget. This type of example, we have to be aware of it because we will see many of them in 2021. So at Coface, and it's going to be my last point, at Coface we have our own methodology to measure, to quantify political risk globally. So we quantify all types of political risk, internal social frustration, of course, and the risk of external conflict. And you see our quantifications on the chart on the right. The number of conflict globally is decreasing from a very high level. This is a good news. But the intensity of each conflict is higher. So it's a kind of balance. That's for the external part. But now, referring to what I said, of course, we see a lot of social frustration in a lot of countries that is increasing. To quantify social frustration in all countries, what we do is we take into account indicators like income inequalities, jobless rate, inflation, corruption. And then we say, okay, in a given country, perhaps there is a high level of frustration, but countries don't have any tool to express this frustration. And by tool, we mean access to the internet, the level of urbanization, the level of education. And when we combine both available tools and a high level of frustration, we think there is a good chance there is some major protest and major unexpected political change in a given country. But this year, is different. So to this usual approach, we have added an exposure to the COVID-19 crisis. Because we think that if in a given country people are most exposed to COVID-19, they will be more likely to turn against their government because they will think that their government has not handled well the crisis. And when we combine both our usual approach for social risk and this exposure to COVID-19, you get this outcome, which shows you that all countries that are both on the right and on the top of the chart are at risk. And you will see a lot of Latin American countries, but also some other large emerging markets that are more on the top of the chart. So they are the ones where we think the risk of social discontent, of social frustration, is the highest in the months and in the quarters ahead. So I'm going to stop here. I've already told too much, I think. This is our usual country risk map. which combines everything. We include our methodologies to better measure the risk of credit risk for businesses on a given country. So we include our own methodology for political risk, all our macro indicators, of course, our payment experience at Coface. We have also added in recent months our assessment of environmental risk. And when you combine all of this, you get this 8-grade scale going from A1 to E. And you see the most recent changes because we update it on a quarterly basis. So I stop here. I've already been too long, and I'm sure you're going to have some questions a bit later on. Thank you.